My dear students, in this an early video, we discussed the theoretical concepts of the mutual fund. In this video, we are going to consider how to measure the performance evaluation of the mutual fund. What do we expect from the fund manager? That is its ability to derive above average returns for a given risk class. For this purpose, it is possible only when the mutual fund manager timing ability is superior and its stock selection is superior. Like in the right time purchase a good, in the right time design a good portfolio and select or choose the better securities. This is what we expect from the fund manager, that we could earn more as related to the risk. The second purpose from what we expect from the fund manager is its ability to diversify the portfolio completely to eliminate the unsystematic risk relative to the portfolio benchmark. Like we have we have two different kind of risk. One is systematic and another one is unsystematic. Systematic risk is market risk, which is undiversifiable theoretically, but at least the fund manager should be able to diversify the unsystematic risk. So my dear, we have different techniques. The first one is the Sharpe Ratio. The second we have Treynor Ratio, Information Ratio, or also we call it Appraisal Ratio, Sortino Ratio, Jensen Alpha, and multi-factors. We will discuss all these, or at least most of these, in this video. The very first technique we are going to discuss is the Sharpe Ratio. It actually based on the risk premium earned per unit of risk. This is the formula of the Sharpe Ratio. By this formula, we can measure the risk performance of the mutual fund. Now, how to do it practically? This is the question. My dear, again, I will give an example in the context of the Pakistan. So, my dear, the very first task is to select a mutual fund. For example, if I'm going to calculate the performance evaluation of the, like, let's suppose Al Habib Asset Management. Okay, my dear, you can select a category from here. Let's suppose I am interested in equity fund. Let's suppose, as in video I told you, okay, these are the different options available. You can select from here. Category, this is the category. Let me select equity category. Now I'm asking ABL Al Habib Asset Management to provide me the equity fund data. Let's suppose from the, you can select a time period from here. Let's suppose I select from the 2nd January 2017 till the, let's suppose I select 1 year data. So I ask him to show report. Okay, my dear, so you can see that this is the equity category, Al Habib stock fund. So you can see that it provides me the net asset value data, that is from the January 3rd 2017 till the December 2017. So here you can see the net asset value. We are supposed to find out the performance evaluation of the mutual fund, for which we need the net asset value data first, so that we would be able to find out the performance evaluation of the Al Habib stock fund. So you can select a data from here. I'm only, for the learning purpose, I'm taking only few figures. Control C, I copy it, and let's suppose I paste it here. Let me change the format. So at the moment I don't need this data. Okay, I don't need this data, so I delete it. This is the inception date, from which date the mutual fund started. I don't need it. So this is the equity fund category. Again, I don't need it. So I only need this net asset value and this date. This is actually the Al Habib net asset value. So my dear, the very first step is to find out the net asset value of the given mutual fund, where you are interested in finding out the performance of that fund. So if you want to compare, you can select the different mutual fund. So the very first task is to download the net asset value data. This is my dear, the purpose of this exercise was to show you from where you can get the net asset value. This actually present the per unit price of a given mutual fund. Okay, I have convert this mutual fund data into the monthly data. For example, this is the HBL net asset value. Now I am going to find out the performance evaluation of the mutual for the HBL fund. So from formula you can see that the formula shows that the Sharpe ratio is equal to return of a portfolio minus risk-free rate divided by standard deviation. Standard deviation means total risk. If you are interested in learning the concept of the why we use standard deviation to calculate the portfolio risk, so this video is already uploaded. You can search for this video. Which I have, we have two video. In one we are covering the concept of the total risk, why we use the standard deviation for total risk, and in second video I have shown that how to calculate the total risk by using the MS Excel. So we are going to repeat it, don't worry. So this is the standard deviation or total risk of the given mutual fund. So my dear, the very first step is to calculate the portfolio return. Why I call it portfolio return? Because this is not investment in a single security. Mutual fund invest in a portfolio. So the return formula is current value divided by previous value minus 1. This is the formula of the return. Similarly, drag it. So my dear, if you see that in early cases the returns are positive because the price is increasing 100, 103, but later on the prices are decreasing. You can see the returns are in negative. There is a purpose why I have mixed the positive and negative. Later on it will be more clear for you. So the first task is to calculate the portfolio return, the average return, summation x by n, or we can write in MS Excel equal average. Okay, so sorry, okay, misspelled, no, it's fine. So this is the average portfolio return. In this case you can see this is the actual value of the RI, which represents the return of the portfolio of the which fund, of the HBL fund. Assume, my dear, the risk free is supposed 2%, and this is the monthly data, so let me divide it on 12. So this is the risk free return, and now you need the total risk of the given mutual fund. For total risk, we calculate total risk by standard deviation. So formula for this is STDEV. So this is the total risk, 1.81%. My dear, the concept of the Sharpe ratio is to find out the risk premium. Risk premium means that if I have two options, whether I can earn this risk-free return or whether I can earn if I invest in the securities in a market. So if I'm taking extra risk, so I should be rewarded by extra return. So this is called risk premium. And then let's see how much this mutual fund is providing me relative to its total risk. So Sharpe ratio, the first task is to calculate the risk premium. So risk premium is RP, return of portfolio, minus the risk-free rate. This is the risk premium. Now to calculate the Sharpe ratio, formula is risk premium divided by the total risk. This is, my dear, the value of the Sharpe ratio. You can see that the denominator is total risk. It shows that by taking 1 unit of risk, our premium return is 0.35. So the more it is high, the more it is preferable. If, for example, there is this is the Sharpe ratio of the suppose of the HBL. For example, if the Sharpe ratio of, for example, al-mizan is, for example, 0.56. This is, for example, the Sharpe ratio of the mizan. So it shows that by taking 1 unit of risk, Mizan mutual fund is providing you how much risk premium? 0.56. So you can see in both cases the unit risk is 1, while the return, the premium is high in the al-mizan. So we will definitely select the Mizan mutual fund. So the higher the Sharpe ratio, the more it indicates that the mutual fund is performing better. So this is the one technique. Okay, there is criticism on the Sharpe ratio. The criticism is that once you are designing a portfolio, then the unsystematic risk should be almost finished. So Treynor consider that the unit risk should be only a systematic risk. His measure of risk adjusted performance focuses on the portfolio undiversifiable risk. Why? Because when you are generating a portfolio, when you are creating a portfolio, the unsystematic risk is almost reached to the zero. So only systematic risk should be considered. Therefore, the concept is same, but this time the unit risk is not standard deviation but only the market risk. You can see that it presents the risk premium. The denominator is now market risk, the beta, instead of the total risk. This expression is the risk premium return per unit of a risk. Risk averse investors prefer to maximize this value. The higher the Treynor portfolio ratio value, the more it is preferable. This assumes a completely diversified portfolio, leaving systematic risk only. There is no unsystematic risk. This is what the Treynor ratio assumes. Because once you have generated a portfolio, so undiversified risk is almost over. Okay, my dear, now let's look to the example. For example, in this case you can see okay, I have already downloaded the index data, but let me show you. You can, like you can see in the formula, now I'm supposed to calculate the market risk of the mutual fund. So for market risk we need the index data, although there are some limitation, but let me consider the KC 100 index data. You can go to the KC stocks website, click on the daily quotation, and you will find out. Okay, let me download this data in Excel form. You can select index data from here. Okay, we have KC 100 index. You can select any composite index or 30 index and select the time period, but be careful that this time period should be similar to this time period of the mutual fund. Like in this case, you can see that I have downloaded the data of the HPL net asset value from January 2021. I have converted it into monthly data, so you can download this data. I have already downloaded it. You can see that this is the index data from January 21 till the December 21. So because sort of the time I convert it into a monthly form. Now you can see that we have the net asset value of the HBL, and on the other hand we have the index. So my dear, we are using this index to find out the market risk of the mutual fund. If you are interested in why we use the beta or why we use index, again I have already uploaded a video where we discuss the concepts of the market risk, and then I have also uploaded a video in which we learn how to calculate the market risk by using the MS Excel. So my dear, in this first task is to calculate the portfolio return. and then second is to calculate the market return, because this market return will be helpful in calculating the market risk of the mutual fund. So this is the return of a portfolio of the HPL, while this is the return of the market as a whole. So my dear, now you can see in formula we need RI means the return of the portfolio. The average return of the portfolio is so this is the RP. Now we need RF assumed as 2%. For example, monthly we calculate it is the 1.00167 or 0.167%. You can convert it into a percentage also, 0.17%. Okay my dear, so then calculate the risk premium, that is RP minus RF. You can see in a formula. So for at this particular stage, calculation of both the ratio is same, but now we are supposed to find out the market risk instead of the total risk. So the formula for the beta by using the MS Excel is equal SLOPE. This formula will help out you find out the market risk of a given security, or in this case of a given portfolio of HPL fund. So this is the value of the beta. Now you can calculate the Treynor ratio, risk premium divided by the beta. So my dear, this is the excess return of a mutual fund in relation to the beta. Again, the higher the Treynor ratio, the more it is preferable. It shows that the fund manager is performing better. Hopefully you got it, my dear. Now another concept is the information ratio. Now the calculations are same. I'm going to avoid again calculations, but let me discuss the concept. The information ratio concept is consider the benchmark instead of the in this case you find out the risk premium. You're not considering the risk free, but you are considering a benchmark. For example, if I when invest in the Mizan fund, and my benchmark is, suppose if I'm investing in the Mizan mutual fund, and I consider that my benchmark should be the, for example, KMI 30 KC Mizan index. So KC Mizan index, these are the index of those firms which are Islamic, according to the Islamic Sharia compliant. Or there might be another mutual fund which you are considering a benchmark for you. For example, if I am considering a Mizan mutual fund a benchmark for me, for example, it is performing best in my industry, so I am supposed to consider a benchmark. I will calculate the return of the benchmark and then calculate of the return of the HBL in this case. Like in this case, we have no matter the here I will consider the net asset value of the my benchmark. So my dear, no, you can okay. Now check out the formula. So you are supposed to find out the difference of this. This is the risk premium, and this time the standard deviation. The standard deviation is not of a given security, but you might having a figure here. For example, if I have, like, let's suppose these are the supposed net asset value of the Misa. Okay, now I'm supposed to calculate the return of portfolio of the HPL, and then I'm supposed to find out the return of the portfolio of the Mizan. Okay, so calculate the return, current value divided by previous value minus 1, and similarly find out the return of the Mizan. Okay, my dear, no, to find out the total risk of the excess return, you are supposed to consider this is the excess return. You are supposed to deduct HPL return from the Mizan, and now calculate the total risk, the denominator in this case. So I didn't consider the standard deviation of the HBL, I didn't consider the standard deviation of Mizan, but the difference of the return of the Mizan and the HBL. So this is how I calculate the total risk or the excess risk. Further concept is same. Okay, this like I am supposed to calculate the return of average return portfolio like this. Okay, this is the return of the HPL, and now this is the return of the Mizan, and then I'm going to find out the excess return. Okay, now this is the excess return. So now I can use the formula, the excess return divided by the excess risk of the, so this is the value of the information ratio. So the high the value of the information ratio, the more it is preferable. So my dear, this is how we calculate the information ratio, and now we calculate the performance of mutual fund while using the Sortino Ratio. My dear, this is a technique in which we consider a downside risk only instead of the total risk. It is almost similar to the Sharpe Ratio. If you can see, the Sortino Ratio is equal to the risk premium divided by the standard deviation of the downside risk. In Sharpe Ratio, we consider the total risk. By downside risk, we means that only those values of the return which are negative. Means some of the investors or some of the people are in favor that you should consider only the negative value in the returns which are negative. We should only consider those values as a risk. We should not consider positive values as a risk. So in this case, Sortino Ratio consider the downside risk only as a denominator. So we are calculating the risk premium in relation to the downside risk. So how to calculate it? Let us take the example from the continue with the example of the Sharpe Ratio. Now this is how we calculate the Sharpe Ratio. Concept is same, but in Sharpe Ratio, where we were calculating the total risk, we calculate the standard deviation by using all the returns value, whether it is positive or negative, while the downside risk mean only consider those values or those returns which are negative, like equal STDEV. This is the value of the total risk or the standard deviation. In this case, we only consider the negative value. So this is the this is the standard deviation of those values which are negative in return. So you can see the difference between the total risk of the by considering all the values and total risk by considering only the negative values. Further, if you can see the formula, the concept is same. We are supposed to calculate the premium return, and then we are supposed to divide it on the downside risk. So my dear, the risk premium formula is RP minus RF, which is already calculated. This is the return of the portfolio of the HPL minus this is the risk free. So now we have the risk premium, and this time we have the total risk, but this time the total risk value is only calculated by using the negative values. So we can now calculate the Sortino Ratio formula is risk premium divided by the downside risk. So my dear, now the value is 2.79, which shows the return premium in relation to 1 unit risk, but that is downside risk only. So higher the value of the Sortino ratio, the more it is preferable, the more it is considered the better performance of the mutual fund. Okay, now we are left with the Jensen Alpha. It is actually based on the capital asset pricing model. You can see that this is the model of the Williams-Sharpe capital asset pricing model. It shows that the left side of the equation, the return that is equal to the risk-free return plus the market premium return in relation to market risk. Now if this both sides are equal, it shows that the manager or the fund manager is performing according to the market. But if the left hand side is greater than the right hand side, suppose this is 12% and this is 10%, it means that the fund manager is outperforming the market by 2%. So in this case, the extra value, now this will be calculated by the alpha. So now we convert this equation in the, into the Jensen Alpha. The risk-free return, we bring it on the left hand side of the equation. We can write it like this. So if this is equal, then the alpha value is 0. But if the two side of the equation is not equal, we will find some value of the alpha. Now the positive value of the alpha means that mutual fund manager is performing better than the market. So the positive alpha value or the greater alpha value is considered the best one. Now how to calculate it? Okay, we will not take the help from the Treynor Ratio data because we need index for this to calculate the beta also. We need RM, we need risk free. So all this data is already available in Treynor Ratio case. So we are supposed to find out first the RP minus RF. This is the left hand side of the equation, and then we need to find out the market premium, that is RM minus RF. So my dear, we already have calculated the return of portfolio minus the risk free. Let me constant it. So this is how we calculate the this is how we calculate the left side of the equation, RP minus RF. Now we are supposed to calculate the market premium, that is RM minus the RF, risk free return. Now my dear, we have the values for both sides of the equation. My dear, we can do it by this way also. If you calculate the beta for the market premium, which already we have calculated, you can see here this is the beta, and you can put the value in this equation also. But let me teach you another method, that is we can do it by using the regression also. For regression, you need to click on data and then data analysis and then select regression. Okay, this is regression. Okay, so it is asking for the input of the y range, means the dependent variable or the left side of the equation. So click this button. This is our dependent variable in this case, or left hand side of the equation, and the right hand or the independent is this. Okay, select the label. It will shows the heading in the table, and then it is asking for the output range, means where you want the result. Let's suppose I want that this function should provide me result in the I column. Okay, click on the OK. So my dear, there are many other values, but we are not interested in other values. We are only interested in the Jensen Alpha. This is, my dear, the coefficient of the RM minus RF, which in this formula is actually a beta. This is the coefficient value of the market premium. So this is the value of the beta. You can see the value of the beta here is also same. So you can do it by the slope formula, which I have already done. Okay, this is actually the alpha, Jensen alpha value. This is actually the value of the alpha. Okay, it shows that the Jensen alpha value is positive and greater than 0, which means that the fund manager is performing better than the market. So the positive alpha value is preferable, and even I should say the high value of the Jensen alpha is preferable. So my dear, if this value is negative, it is not preferable. The negative means that the fund manager is performing, that is not performing better than the market, or it is performing worse than the market. Hopefully you people got it. There are many there are some other models also, like I have wrote here the multiple factors, like the Fama and French 3-factor model or the momentum 4-factor model. But at the moment, this is enough for this particular video.